In today's video, I'm going to explain over 100 stock market terms that every beginner should know. To make it simple, I've divided everything into 9 simple topics. So, if you want to finally understand how the stock market works and learn some essential investing terms, this video is definitely for you. Welcome to Martic Finance, where we explain investing concepts in a simple way. But first of all, a quick disclaimer. This is not financial advice. Let's start with the most important question. What is a stock? A stock represents ownership in a company. If you own a stock, you literally own a piece of that business. There are 2 main types: common stock and preferred stock. Common stock is what most investors buy. You get a claim on the company's profits and the right to vote on big decisions, but dividends aren't guaranteed. Preferred stock is different. You usually don't get voting rights, but you're more likely to receive steady dividends, and you get priority if the company pays out money to shareholders. Now, instead of just owning one stock, most investors build a portfolio. A portfolio is simply a collection of all the investments you hold. Some of those investments might pay a dividend. That's when a company shares part of its profits directly with shareholders. But not every company's stock is available to the public. A public company is one that has listed its shares on the stock market, while a private company keeps its shares owned by founders or private investors. To measure how groups of stocks are doing, we look at something called an index. An index is a collection of stocks designed to represent a piece of the market, and it's used as a benchmark for performance. For example, the S&P 500 tracks 500 of the biggest U.S. companies. The NASDAQ is known for tech stocks, and the Russell 2000 tracks smaller companies. When investors talk about trying to beat the market, they usually mean earning a return that's higher than one of these major indexes, especially the S&P 500. Since the S&P 500 is often treated as the standard benchmark, if your portfolio does better than it, you've beaten the market. This is actually really difficult, and only a few investors manage to do it. All these stocks trade on a stock exchange. That's the marketplace where buying and selling happens. The largest in the US is the New York Stock Exchange. To actually trade, you'll need a brokerage, a platform or service that connects you to the exchange. They may charge a commission, which is just a fee for making the trade. Every stock is identified by a short code called a ticker symbol, like AAPL for Apple or TSLA for Tesla. Trading happens during official market hours, typically 9:30 a.m. to 4 p.m. Eastern Time. The stock price is the current price of one share. At the start of the day, we have the opening price, and at the end, the closing price. But trading doesn't stop there. There's pre-market trading before the open, and after-hours trading once the market closes. This is when investors can still buy and sell stocks outside of normal hours, often reacting to news like earnings reports or economic announcements. The catch is that these sessions usually have lower volume and lower liquidity. Here is the volume, which shows how many shares are being traded. High volume means lots of activity, while low volume means fewer trades. And finally, liquidity, which tells you how easy it is to buy or sell a stock without moving the price too much. Big popular companies like Apple or Microsoft are very liquid. We'll start with market capitalization, which is the total value of a company's stock on the market. You simply multiply the stock price by the number of shares. Then, there is the enterprise value, which looks not just at stock, but also at debt and cash the company holds, giving a fuller picture of what the business is worth. Revenue is the total income from sales. After expenses are subtracted, what's left is net income. That's the profit. On the balance sheet, you'll also see assets and liabilities. Assets are what the company owns, like cash, equipment, or property. Liabilities are what it owes, things like loans or debt. Now, to compare companies, investors use ratios. One of the most common is earnings per share, EPS. This shows how much profit is made for each share of stock. For example, if a company earns $100 million in profit and has 50 million shares available, the EPS would be $2 per share. From there, we get the price-to-earnings ratio. It compares the stock price to the earnings per share, showing whether a stock looks expensive or cheap compared to its profits. The PEG ratio goes a step further. It's the PE ratio adjusted for expected growth, helping investors see if a fast-growing company's stock is fairly valued. For income-focused investors, there's dividend yield. This measures how much you earn in dividends compared to the stock price. Another key factor is free cash flow. This is the cash a company has left after paying its expenses and investments. It's what can be used for dividends, buybacks, or growth. Finally, let's look at profitability margins. Gross margin tells you how much money a company keeps from sales after paying for the direct costs of making its product. Operating margin goes a step further, showing what's left after paying for things like salaries, rent, and other business expenses. Finally, net profit margin is the true bottom line, the percentage of revenue left after all costs, including taxes and interest, are taken out. A growth stock is a company that's expected to grow quickly, often reinvesting profits instead of paying dividends. Think of tech companies that focus on expansion. A value stock is the opposite. It's a company that looks cheap compared to its fundamentals. Investors buy them hoping the market will eventually recognize their true worth. Then we have blue chip stocks. These are large, well-established companies with strong reputations, like Coca-Cola or Johnson & Johnson. They're considered stable and reliable. Some stocks move with the economy. These are called cyclical stocks. For example, car companies or airlines usually do well when the economy is booming, but struggle during recessions. On the other hand, defensive stocks are more stable in any economy. Companies that sell essentials, like food, utilities, or healthcare, tend to hold up even in tough times. Stocks can also be grouped by size. A large cap company is worth over $10 billion, a mid cap is between $2 and $10 billion, and a small cap is under $2 billion. And finally, penny stocks are very low-priced shares, usually under $5. They're highly speculative and risky, but sometimes attract investors looking for big wins. A mutual fund pools money from many investors to buy a mix of stocks, bonds, or other assets. A professional manager chooses the investments and adjusts the portfolio over time. An ETF, or exchange-traded fund, works a lot like a mutual fund, but trades like a stock on an exchange. You can buy or sell it anytime during market hours, making it flexible and easy to trade. Many ETFs track a whole market index or a sector, like technology or healthcare. An index fund is a type of mutual fund or ETF that simply tracks a market index, like the S&P 500. Instead of trying to beat the market, it aims to match it, which keeps costs low and makes it a favorite for long-term investors. Some funds are more specialized, like a hedge fund, which uses advanced strategies like short selling or leverage to try to generate high returns. Hedge funds are usually for wealthy investors because they carry higher risk and require more capital to get started. There are also tax-advantaged accounts like a Roth IRA, which allows your investments to grow tax-free. You contribute with after-tax money, and when you retire, withdrawals, including growth, are generally tax-free. It's a popular way to save for retirement. Beyond stocks and funds, there are commodities like gold, oil, or agricultural products, which can be bought directly or through funds. Bonds are essentially loans you give to a company or government. In return, they promise to pay you interest, usually at a fixed rate, over a set period, and then return your original investment, called the principal, when the bond matures. Currencies let you invest in money from around the world, like dollars, euros, or yen. And then there's cryptocurrencies, like Bitcoin or Ethereum, which are digital assets that trade independently of traditional markets. One key concept is volatility, which measures how much stock prices move up and down. Highly volatile stocks swing a lot in price, while low volatility stocks are more stable. Investors often track the VIX, also called the Fear Index. It measures expected volatility in the S&P 500 over the next 30 days. When the VIX is high, it shows that traders expect big swings in the market. A bull market happens when prices are rising over a long period. Optimism is high, and investors are confident. The opposite is a bear market, when prices are falling and pessimism dominates. Sometimes the market pulls back temporarily without changing the overall trend. This is called a correction, usually a drop of about 10% from recent highs. When prices climb sharply after a dip, that's a rally. On the extreme end, a crash is a sudden and severe drop in stock prices, often caused by panic or major events. A market bubble happens when prices rise far above a company's actual value, driven by speculation or hype. Eventually, bubbles burst, and prices can fall dramatically. Finally, market sentiment describes how investors feel about the market overall. Are they optimistic, fearful, or somewhere in between? Sentiment can strongly influence trends, sometimes even more than company fundamentals. Passive investing is a long-term approach where you buy a broad market index or fund and hold it, without trying to pick individual winners. It's simple, low cost, and often matches market returns. A common tactic within passive investing is dollar cost averaging, or DCA. This is when you invest a fixed amount regularly, like every month. It helps smooth out market ups and downs over time. Alternatively, lump sum investing is putting a large amount of money in the market all at once. While it can grow faster if the market rises, it's riskier if prices drop right after. Active investing is the opposite of passive. Active investors pick individual stocks or try to time the market to outperform the averages. Some strategies are about timing and opportunity. Buy the dip means purchasing a stock after it drops in price, hoping it will recover. Buy and hold is simply buying good companies and holding them for years, letting compounding work its magic. Market timing is trying to predict the best moments to enter or exit the market. It's very difficult and risky, even for professionals. Some approaches are more analytical. Speculation is taking high-risk positions hoping for big gains, while fundamental analysis studies a company's financial health, management, and industry. Technical analysis looks at price charts and trends to forecast movements, and macro analysis examines the overall economy, interest rates, and global trends to guide investment decisions. One of the most famous corporate actions is the initial public offering. This is when a private company sells shares to the public for the first time, opening up ownership to everyday investors. After a company is public, it might do a secondary offering, issuing additional shares to raise more money. Sometimes a company wants to reduce the number of shares on the market. A buyback or share repurchase happens when a company buys its own stock, which can increase the value of remaining shares. A stock split increases the number of shares by dividing existing ones. For example, in a 2-for-1 split, you get 2 shares for every one you own, and the stock price is halved. A reverse stock split does the opposite. It combines shares to increase the price, often to meet exchange requirements. Companies also grow by buying others. An acquisition happens when one company purchases another, which can affect stock prices for both. Investors in dividend-paying stocks should know key dates. The ex-dividend date is the cutoff to qualify for the next dividend. The payment date is when the dividend is actually sent to shareholders. Finally, an insider is someone with access to non-public company information, like executives or board members. Insider actions and trades are closely monitored to prevent unfair advantages. One of the most important tools is diversification. This means spreading your investments across different stocks, sectors, or asset types, so that a loss in one area doesn't sink your whole portfolio. Asset allocation takes diversification a step further. It's about dividing your money between different types of assets, like stocks, bonds, or cash, based on your goals and risk tolerance. Over time, some investments grow faster than others, which can throw your portfolio out of balance. Rebalancing is the process of adjusting your holdings to return to your original target allocation. Investors also measure performance using metrics like alpha and beta. Alpha shows how much a portfolio outperforms or underperforms the market. Beta measures how sensitive your portfolio is to overall market movements. Higher beta means more volatility. The Sharpe Ratio is another key metric. It shows how much return you're getting for the risk you're taking. A higher Sharpe Ratio means better risk-adjusted returns. Correlation tells you how closely two investments move together. If two stocks are highly correlated, they tend to rise and fall together, which affects your diversification strategy. Finally, understanding types of risk is crucial. Systematic risk affects the entire market, like recessions or interest rate changes. Unsystematic risk is specific to a single company or sector and can usually be reduced through diversification. Inflation is when prices for goods and services rise over time, which means your money buys less than before. Deflation is the opposite, when prices fall, which can slow economic growth. Sometimes the economy faces a rare situation called stagflation, where prices rise but growth stalls and unemployment is high. A recession happens when the economy shrinks for several months, often measured by falling GDP. During recessions, companies earn less and stock prices often drop. Governments and central banks use different tools to manage the economy. Monetary policy is controlled by central banks, like the Federal Reserve in the US, and includes actions like changing the interest rate or controlling money supply to influence growth and inflation. Fiscal policy, on the other hand, is what the government does with spending and taxes. Increasing spending or cutting taxes can stimulate the economy, while reducing spending or raising taxes can slow it down. And that's a wrap for today's video. Of course, we didn't dive deeply into every single term because the goal was to cover as many stock market terms as possible for beginners. If you found this video helpful, I'd really appreciate it if you liked this video and subscribe to the channel for more content like this. Thanks so much for watching, and I'll see you in the next one. Bye.